Imagine a world where the second largest economy's heartbeat starts to falter, not because of trade wars or market crashes, but because it's running out of the very lifeblood that powers it: oil. This isn't a dystopian future, it's a looming reality for China. Hey, welcome to Fun Financial Insights. Now, in today's episode, we're embarking on an oil odyssey with China, a true story of economic triumphs, geopolitical maneuvers, and a thirst for the black gold that could spell disaster or deliverance. With recent data indicating China's oil consumption reaching 16.41 million barrels per day in early 2024, the nation's reserves are under the microscope. China's strategic oil reserves, crucial for buffering against market volatility, have been a closely guarded secret. However, recent trends suggest that China's stockpiling efforts may not keep pace with its voracious appetite for oil. As of now, China's reserves are estimated to sustain its current consumption rate for only a few months, making every barrel a precious commodity and every diplomatic maneuver a critical play. Let's dive deeper into the intricacies of China's oil saga. In early 2024, reports surfaced that China's oil reserves were hitting rock bottom. It was the economic equivalent of your phone flashing the dreaded low battery warning while you're miles from a charger. With oil reserves drying up, the ripple effect was immediate. The stock market twitched nervously, commodity prices soared, and the yuan took a nosedive. It was a stark reminder of how China's market is tethered to the lifetime of oil. A full-blown shortage could have led to a domino effect: energy rationing, industrial slowdown, and an inevitable market crash. China's oil consumption is a behemoth, chugging down about 14 million barrels per day. To put that into perspective, that's like draining an Olympic-sized swimming pool every 15 minutes. When the reserves neared depletion, the country was staring down the barrel of a 1.2 million barrels per day deficit. That's a lot of unpowered pools. This scare was a wake-up call for China. But how did China get to this level? Well, the 1950s saw the first waves of change as China embraced industrialization with the help of Soviet expertise. The first five-year plan laid the groundwork for a state-controlled economy, focusing on heavy industry and infrastructure. It was a time of growth and turbulence as the Great Leap Forward aimed to catapult China into the industrial age, but instead led to economic breakdown and famine. Fast forward to 1978, and China stands at a crossroads. The introduction of market principles and the opening to foreign investment turned the tide, setting China on a path to becoming an industrial powerhouse. From the late 1970s onwards, China's GDP growth averaged over 9% a year, lifting almost 800 million people out of poverty. The country's shift from collective farming to the household responsibility system, and later the embrace of global trade, fueled a period of explosive growth. By the turn of the millennium, China had established itself as a major global exporter. Today, China stands as the world's second largest economy, a testament to its remarkable journey of growth and transformation. And with this also comes its huge need for oil. The year 1993 was a game-changer for China. As the dragon's appetite for energy grew, its own oil production could no longer keep up with the soaring demand. The scales tipped, and China became a net oil importer for the first time in its history. Now, oil is not just a commodity, it's the economic lifeblood that keeps industries pumping and vehicles moving. It's the hidden force behind every product we use. The impact of oil on the economy is pretty profound. Fluctuations in oil prices can dictate the fate of nations. For China, becoming a net oil importer meant its economy was now at the mercy of global oil markets. In 2023, China's oil imports soared to 11.3 million barrels per day, a 10% increase from the previous year. Russia, Saudi Arabia, and Iraq became key players in quenching China's thirst for oil. With each barrel imported, China weaves a tighter bond with the global economy, but also exposes itself to new vulnerabilities. Hey, if you're riveted by China's oil escapade, don't touch that dial. Pay attention as we are about to navigate the treacherous waters of the Malacca Strait, uncover the geopolitical chessboard, and reveal how China is fortifying its oil lifelines. But before we sail further, hit that like button, smash subscribe, and ring the notification bell to know every time we post a new video. Also, share your thoughts in the comments below. How do you think China's oil dilemma will unfold? Now, coming up, we'll look into the high-stakes world of international diplomacy. How does China manage its relationships with oil-rich nations? What's the secret behind its Belt Road Initiative? And most importantly, how does all this affect you and your wallet? The Malacca Strait, a slender thread of water between the Malay Peninsula and the Indonesian island of Sumatra, is more than just a passage. It's a lifeline for China's oil supply. This strait is the shortest sea route connecting the oil-rich Middle East to the bustling ports of East Asia. It's the economic jugular for China, channeling about 80% of its oil imports, which represents 60% of its entire oil supply. The sheer volume of trade that transits through these waters is mind-boggling. We're talking about $3.5 trillion of global trade annually, with two-thirds of China's maritime trade volume passing through here. But why is the Malacca Strait so critical? Well, it's all about location, location, location. It's the primary choke point in Asia, with between 85% and 90% of annual total petroleum flows being crude oil. A disruption in the Malacca Strait wouldn't just be a local issue, it would send shockwaves across global supply chains, affecting markets and economies worldwide. So in response, China is weaving a complex web of strategies from the Belt and Road Initiative to military presence, all aimed at safeguarding this vital trade route. While China is exploring responses like military presence, it actually needs to be more diplomatic because it cannot afford a war currently. Why can't China afford a war? Well, the answer is twofold: economics and energy security. A war could disrupt China's oil supply, which is crucial for powering its economy. Moreover, the financial burden of conflict could derail the country's growth trajectory. China's concern goes beyond just the availability of oil. It's about access. With countries potentially limiting China's reach to its precious resource, the stakes couldn't be higher. So, what's China doing about it? Diplomacy is the name of the game. China is engaging in a global diplomatic offensive to secure its oil access, forging alliances and investing in alternative routes to circumvent potential blockades. A great example is the Belt and Road Initiative, and I'll talk more about that soon. While China is using the project as a way to maintain access and create alternative trace routes, China is also using this project as gifts that curry the favor of trading partners. For a picture of how this partner relationship management is working, let's see some of the countries that supply China oil. Russia has been a top supplier, providing 19% of China's imports, amounting to 2.1 million barrels per day in 2023. The ties have grown stronger, especially after discounts related to sanctions on Russian oil following geopolitical tensions. Iran's oils come with a catch: sanctions. Yet China imported about 1.05 million barrels per day from Iran in 2023, often relabeled as originating from other countries like Malaysia, to navigate around the restrictions. Qatar plays a different role in China's energy mix, focusing on liquefied natural gas, LNG. In 2023, China's imports from Qatar were valued at $20.93 billion, with a significant portion being mineral fuels and oils. Saudi Arabia, a long-standing oil ally, supplied China with 1.75 million barrels per day in 2021, and the numbers have only grown since then, highlighting the kingdom's crucial role in China's energy security. China doesn't put all its eggs in one basket. It has diversified its oil sources to include countries like Brazil, with imports increasing by 52% in 2023, and the United States with an increase of 81%, ensuring a robust supply chain. This web of countries, some allies, others not so much, are just some of the relationships China has to manage to keep its economy afloat. This means securing the trade in separate ways for each party. Let's take a closer look at China's Belt Road Initiative and how it's reshaping the country's international relationships. Launched in 2013, the Belt Road Initiative is China's grand plan to connect continents and open new corridors of trade and influence. It's a modern-day Silk Road, stretching from the shores of East Asia to the heart of Europe and Africa. With investment surpassing $1 trillion, the BRI encompasses a staggering array of projects, including railways, highways, ports, and digital infrastructure. Now, over 150 countries have signed up for the BRI, each enticed by the promise of economic growth and development. From the mountains of Central Asia to the deserts of Africa, China is weaving a tapestry of partnerships through infrastructure. China's approach to managing its relationships through the BRI is multifaceted. It involves policy coordination, financial integration, and fostering people-to-people bonds. The initiative is as much about building infrastructure as it is about crafting lasting partnerships. The BRI is also about soft power. China is investing in building a foundation for long-term relationships that go beyond mere economic transactions so that it can ensure the safety of the things that will keep its economy running. China's military footprint is stepping out of the shadows and onto the world stage. With ambitions to protect its interests far and wide, China is establishing a network of overseas military bases. Djibouti, home to China's first overseas military base, is a testament to its new era of Chinese power projection. Strategically located at the Horn of Africa, it serves as a gateway to the Suez Canal, a vital maritime choke point for global trade. But the People's Liberation Army Navy isn't stopping there. Reports suggest China is eyeing new military facilities in countries like Pakistan, Cambodia, and even as far as the United Arab Emirates. China's defense budget has been on a steady climb, reaching over $250 billion in 2023. This financial muscle is backing up its global ambitions, with the PLA's troop strength standing at an impressive 2 million active personnel. Take the Ream Naval Base in Cambodia, for example. It's rumored to be the site of China's next military facility, a move that would significantly enhance its ability to operate in the South China Sea and beyond. China's military presence is not just about bases, it's about influence. By securing strategic locations, China ensures its voice is heard in regional disputes, and its trade routes for commodities like oil remain open and safe. The Gulf Cooperation Council, GCC countries, are pivotal to China's energy security. In 2020, China surpassed the European Union as the GCC's largest trading partner, with bilateral trade reaching new heights. China has also inked 17 free trade agreements and is negotiating 8 more, creating a web of economic ties that span from ASEAN to Switzerland and from Chile to Australia. While China's dependence on oil may be increasing due to its economic demands, China is also making sure that with all these plans and more, the market crash and effect on its economy can be combated as much as possible. China's economic maneuvers, from the Belt Road Initiative to its military expansion, have far-reaching impacts. These moves can affect commodity prices, global trade, and investment returns, creating ripples that reach the shores of our personal finances. Now, for you, the individual investor, China's global strategies could mean fluctuations in the stock market, changes in oil prices, and shifts in currency values. It's crucial to understand how these macroeconomic factors can influence your savings and investments. To navigate these waters, you must be prepared. Diversifying your investment portfolio can help cushion against market volatility. Building an emergency fund ensures you have a lifeline when the economic tides turn. As we sail towards the horizon of this episode, remember that the global economy is a vast ocean, and China's strategies are but one of many currents. Your personal finance ship must be well equipped to handle any storms that may arise. Hey, don't forget to hit that like button as well as share this video with friends and family members. To get all the newest tips regarding investments and fun financial insights, subscribe and turn on the notification bell to be notified immediately we upload a new video. All right, we'll see you in the next video on Fun Financial Insights.